Oh boy, this is going to be so much fun. Why? Because now we begin our long journey, our long march up the mountain that is stocks. Exciting stocks. Sexy stocks. Oh, risky stocks. And we begin with a couple of quotes, which I like, from Will Rogers, a humorist from the mid 20th century. I think he's the one who quoted, "There are no strangers, just friends I haven't met yet." Don't gamble. Take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it. Very wise advice. Yeah. And, their generations from the Great Depression always felt that stocks were gambling after they had been burned to the tune of an 86 or 89% drop in the stock market. And then a joke that I love to tell. How do you make a small fortune in the stock market? Oh, it's easy. You just start with a large fortune and then you make a small fortune. Oh, yes, stocks are, as we'll see, are risky, but the rewards are great. If we're prudent, if we're long-term oriented, you just stick with us. Slide number 2. What are stocks? Anyway, first of all, I hate that name. It's a terrible name. I try to get people to think of the business. Think of the products and services that are being provided. Yeah, stock is just so... It doesn't make sense to people. What does it mean? Well, the term came from the creation of these entities called corporations in the 1600s, when the New World, when Europe was expanding around the globe, and they needed capital, which is a fancy word for money, resources. So investors were shareholders in common. Every share was one vote. And however many votes you had that many. However many shares you had that many votes. So stocks represent ownership, as we discussed in chapter 1. Equities is the term we often use. Equity financing. You are part owner, and it enables you as an investor to participate in the profits and the growth generated by the business enterprise. Very cool. You're a business owner. Think about it that way, as opposed to, I got this stock. But one of the cool things that we don't often think about, but you would learn in an introduction to investments, introduction to business class, Business 120 in our school, or a business law class, Business 140 at Southwestern. Stockholders are limited liability owners. What does that mean? That means you buy one share for $100 and the company, the corporation, the business fails and has tremendous debts. Well, they can't come after you for more money. You lost your $100, okay, but they can't say, you know what, the corporation still owes this much money to such and such. No, you are limited liability owners. That's very different from a partnership or a sole proprietor, where you and the business are one, and whatever debts the business creates, you're on the hook for them. Now, can you imagine that certain individuals who, well, exactly, there are people who will create these sham corporations just so they can hide debts and hide assets and then walk away without any. Well, the judges, the courts, the lawyers, they've seen this, and they have a way to pierce the corporate veil if the person or entity is trying to get away with something untoward. So you would learn more about this in a business law in an introduction to business class. So we don't discuss that too much here. But we do know that we are limited liability owners. We're only on the hook for whatever we invest. Now, why invest in stocks? Well, dividends, which are optional payments of earnings. There's no guarantee that there's no mandatory payment of dividends. When stocks earn money, they can distribute those earnings in the form of dividends. And if you've taken accounting, you've maybe Remember the term retained earnings? The earnings that were not paid out as dividends were retained by the corporation. Yeah. And then capital gains, which is what most people concentrate on. We also call it capital appreciation. There's also capital losses. If the corporation does well, if the business does well, new markets, new products, whatever, the business grows and your stock price should go up. Now, it's not always the case that it's going to happen that way, but that's the general rule. Contrary to what many believe and how many people behave, stocks are not simply millions and millions of worthless pieces of paper that people trade every day. Well, now there's no more paper, it's all electronic bits. They represent ownership in real businesses, folks. So if you own one share of FedEx or UPS, when those trucks go driving down the road, you can take a look at it, and your one share is that left lug nut. The one lug nut on the left front tire. You're right, the corporations are huge and we are very small little entities. But still, we get to share in the appreciation. Very cool. What has been the historical performance on slide number 3? Over the long term of modern finance, and we don't want to get into the historical reasons why we call it modern finance, but since the 1910s, 1920s, the return from the stock market as measured by the Standard & Poor's 500. What's that? We'll discuss that. Don't worry, we've been dancing around this thing. It's a measurement. It has been approximately 10 or 11% over the last 90, 100 years. But in any one year, it is unlikely that the return will be 10 or 11%, right? As we saw, the return has varied. The standard deviation is great. High of almost 54% to a low of over 43% net loss. And 2008 was a loss of 38.5%, although the market actually went down from peak to trough, from the high to the low, over 50%. But that's going to happen, as we said. We know it's going to happen. We just don't know when. If we knew when, then okay. So there's a very good chance that you're going to live through a couple of these if you start early, but you're not going to panic, right? Exactly, because we're going to give you tools to, you saw the dollar cost averaging in chapter 2, and we're going to come back to that. So stick with us. Any given year, there's about a 1 in 3 or 1 in 4 chance that the market will be down. Now, wouldn't it be cool if it went up 1, 2, 3 years and then down 1 year and then up 1, 2, 3 years? And it doesn't work that way. From 1982 to 2000, the stock market went in 2 directions, up and way up, and then went down 3 years in a row. So you just don't know. You just don't know. And that's why we're going to take a long-term perspective and learn how to deal with the downturns and actually use them to our advantage, right? When do you want to buy things? When they're on sale. The problem is, how low can they go? Well, they can go pretty low, so it can be a roller coaster. Slide number 4. Here's that graph that we had the warning, right, with the logarithmic scale in chapter 1. Yeah, the news is good, folks. If we have a long-term perspective, don't panic when the markets fall, because they inevitably will. And the world doesn't end. We got to throw that in there. Then we should do well. I'm very optimistic. I keep telling you this. I hope you believe me. Economically, technologically, I'm terrified politically. Because dictatorships are not good for economies, typically. Yes, but notice that stocks have literally clobbered other popular investments. I mean, we talked about the logarithmic scale. It looks like bonds are about half. No, bonds are, it's orders of magnitude smaller return than stocks. But still, bonds, which we'll get to after we're done stocks, have done better than short-term investments, treasury bills, and inflation. And this is from the Stern School of Business at New York University and some information from the Federal Reserve Bank. And every year in January, I await they come out pretty quickly within a few days of the new year. I eagerly await their publishing of this information because it's so cool. Okay, and then if we go back to the chapter 1 graphic where we showed going back to the beginning of the Industrial Revolution, we see that stocks have just exceeded all belief. You know, I mean, 70 million. $1 becomes 70 million. Now, obviously, nobody lives for 200 years, but still, if you are so inclined, read an historical novel from the early 1800s or late 1700s and realize that our standard of living has just, for anyone living at that time, they could not even imagine the kind of life that we live now. Just they could not even begin to imagine it. And so I'm a big Beethoven fan. Beethoven's my favorite composer. And I often think, what would Beethoven be able to do now? And they have some of his DNA, so I don't know. I don't think that's not very ethical, but I would sure love to resurrect the guy and see what he can do with the technology and the music that's available now. So, have I convinced you yet? Are stocks the way to build long-term growth? Well, we got a lot more to learn. And you may decide after all these 5 chapters, 3, 4, 5, 6, 7, that you don't want to pick individual stocks. Well, that's fine. That's fine. That's why we have mutual funds who will choose the investments for us. But I hope that you catch the bug. I hope that you find that this stuff is really kind of exciting because there are thousands of stocks, thousands of businesses, and every single business has a different story. And some of them are very boring, which I love. Some of them are really exciting, which means they're also kind of risky. Some of them are scoundrels and have perpetrated horrible things upon the public, but most not. Most are people just trying to get through the day. Indeed. So let's continue. However, now that we've said the news is good, we got to look at the downside, right? Here is another way to look at the stock market. And this is the Dow Jones Industrial Average. You usually just called the Dow. It's just a list of 30 companies that changes over time. And what we see that if we take a 10-year time horizon, and that's often done, although I think a longer time horizon is more important, and we showed you mutual funds that have been around for over 50 years, one over 90 years. If we take a 10-year time horizon, then what happens? Well, starting in right before the Great Depression, we see rolling 10-year periods where we lost money. You put $100 or $1,000 into the market, and 10 years later, you had less than what you put in. But here we come out of the Great Depression, out of World War II, and the go-go years, science and technology, and we beat fascism. It's coming back, but we beat it, and we beat totalitarianism. It's coming back. But the market went in 2 directions, up and way up, and you had 10-year periods where the market almost returned 20%. And what did you hear people say? Ooh, is it too late to get in? Right. When you hear people say that, the answer is usually no. Yeah, so yes, it's too late to get in. No, don't do it now. But get ready for volatility, which is our euphemism, our fancy way of saying I lost a lot of money. Yeah. Because then we had the Vietnam War, the culture problems, the culture wars, the civil rights, women's rights, gay rights, the first gas crunch, 1973. Some of you don't believe me, just type it in. The first gas crisis. The second one was 79, and you'll see lines of cars waiting for oil, waiting for gasoline, over a mile long, and the market was quite expensive because of those go-go years. And sure enough, we see a rolling 10-year period that just barely lost money. We just barely eked out a gain over 10 years into the 1970s. Very difficult time for the economy, very difficult time for the country. Watergate. And what did you hear people say after the 74 bear market, which was pretty brutal, 50%? Oh, is it too late to get out? And when you hear people say that, depending on the investment, the answer is usually, yeah, it's too late to get out. Now's the time to be buying, but who wants to buy when it keeps falling? And then what happened? We come out of that time, stocks are already pretty low prices, and now we have new technologies, computerization, microcomputers. We get these little, well, not little, they're bricks, mobile phones, and then they become a lot smaller. And then we have this bizarre thing come out of nowhere from the military of all places, the internet, and blue skies, productivity gains as far as the eye can see. And the stock market went in two directions, up and way up, and you had rolling 10-year periods that almost touched 20%. And of course, it's 1999, and we're partying like it's and what do you hear people say? I hope you understand, right? I hope you realize, is it too late to get in? Yeah. Yeah, I remember looking down at the Quotron machine and seeing a number that just struck me, and I'll come back to it later on. It's not going to last. I knew it wasn't going to last. I didn't know when it was going to end. I figured it would end about 2003. The end started in 2000, March of 2000. And it was too late to get in. In fact, the internet bubble bursting, and then the real estate bubble bursting, and here we are in the global financial crisis, the Great Recession, 2008 and 9, and you had rolling 10-year periods where the market went down. Do you see this pattern coming? What did people say? Oh, is it too late to get out? Yeah, right. And since then, the market's done pretty darn well. Now, do I believe we're going to do this same thing where we touch 20%, close to 20%? I don't think so. I think it's going to modulate, but that doesn't mean I'm right. It could all crash tomorrow, But the takeaway is that we have to think long term. We have to remember that stocks are a long-term investment. And yet there are people who buy and sell them every day, and we call them traders. We call them speculators. We do not call them investors. Investors are in it for the long term. In my humble opinion, you decide. Go back to chapter 1 and read what Jack Bogle of Vanguard said. Yeah. Slide number 7. Traditionally, close to half of the returns from stocks was from reinvested dividends, because stockholders used to expect 4 to 6% in dividends each year, which was as much or more than bonds returned in interest, since stocks were considered much riskier than bonds. So if we go back to 1936 to 2008, we see that stocks returned about 3.8% in dividends alone. And when you reinvest those dividends in more stocks, you get what's called compound return. So that 10% that we tell people bandy about 8, 9, 10%, half of that came from dividends. But in the 1980s and especially 1990s, the dividends fell to less than 2% and even 0% for a lot of companies, because people wanted capital gains. People wanted growth. They said, don't pay me dividends. I want you to grow the company. And so between 1997 and 2000, the dividend averaged 1.5%. It's down below that now. Okay. Reasons given, what? Dividends were taxed at a higher rate than capital gains. Well, that's not true anymore. People wanted the business to reinvest the earnings for growth instead of distributing it to the investors. Yeah. Stocks were no longer considered riskier than bonds. There were a few books that came out at the end of the 90s saying, stocks are not as risky as bonds. So bonds are actually more risky than stocks when you take into account purchasing power risk and inflation risk. And don't you believe them? Stocks are riskier than bonds. Savings accounts were also paying 2% at the time. They're paying some are paying a little bit more, some are paying less. And of course, there's always the people lost track of their senses and bid up the prices. Well, that's often the case. And sure enough, dividends became much more important in 2002 after 3 years of capital losses. Here is a graph that shows you the yield on bonds, what bonds are paying in interest versus the yield on stocks, what stocks are paying in dividends. And if we go back to 1960, we see that they're pretty darn close to one another. Pretty darn close to one another. Bonds are paying a little over 4%, and stocks are paying a little less than 4%. Remember that 3.8%. Then what happened? Well, in the 1970s, inflation started to take hold. We had all that turmoil in the economy and the culture and the country. And so when inflation hits, bondholders say, oh, no, you got to pay me more interest. You got to pay me more interest. And then because stocks had fallen so far, the prices go down. The dividends that they pay then are a greater percentage. And so the percentage that stocks were yielding hit, almost 6%. Yeah. And then what happened? Well, it's a long story. But in 1979, 78, inflation was starting to look really ugly. And President Jimmy Carter, who just recently passed away, went to the new Federal Reserve chairperson, Paul Volcker, and said, Mr. Volcker, we got to do something about inflation. And Mr. Volcker said to Mr. Carter, well, Mr. President, yes, we can do something, but it'll probably cost you the election. And Carter, to his credit, just like Biden, unlike Agent Orange, what's his name? I forget. Anyway, said your job is to tame inflation. That's what the Federal Reserve Bank's job is to do. And so you do what you need to do. And Mr. Volcker and the Federal Reserve Bank system cranked up interest rates to the point that bonds were paying over 15%, but just for a very small period of time, because then inflation started to fall like crazy, because that's exactly what caused the worst recession since the Great Depression in 1982. But it worked. And you see interest rates falling and the dividend on stocks falling. Why? Because the prices are going up. So now the dividends are a smaller percentage of what the price is. Until finally the year 2000, when the dividend hit 1%. March of 2000, when the internet bubble hit its peak. And then you see the dividend going back up as prices fall. The interest rates falling continually until 2008. And what happened? You had a very unusual situation where, because bonds were paying almost nothing now, and stocks prices had fallen, the dividend yield was higher than the dividend yield on stocks was higher than the interest yield on bonds. And that should be this huge red flashing light saying stocks are dirt cheap. And of course it was, but who wants to buy when they just seen the stock market lose over 50%? But since then, we see that for the next 10 or 12 years or so, we see that the two are bouncing back and forth, which again is usually a good sign for stocks, and the stocks have done very well. Well, what happened? That darn microbe. Stupid COVID. And we had inflation from the shutting down the economy. There were a lot of, all reputable economists said, you know what's going to happen, don't you? If we shut down the economy, we're going to have inflation when we try to open it back up again. But it was, I think, the right thing to do, because there were some people saying, no, don't shut down the economy, let people die. The one senator from Texas saying, we old people should be willing to give up our lives to save the economy. The problem is it's already been tried back after World War I with the Spanish flu. Parts of the country and parts of the world tried to keep their economies open, and the virus shut it down because it put so many people out of work and killed a lot of people. So it shut down the economy just because the people were sick. So I think, of course, everyone has their opinion. And you can't go back and try it. You can't go back into 2020 and try again. But I think they did the right thing. But they knew inflation was going to hit, and of course it did. And so the Federal Reserve Bank had to raise interest rates. Now they've raised them, and they've just ticked down a little bit, but they're still going to keep them up above 4%, in my humble opinion. So we'll see. But notice the yield on stocks, because stocks are pretty expensive now, folks. We'll see what happens. That doesn't mean they can't continue to rise, but I'm getting prepared emotionally. You got to prepare emotionally. Cool? Okay. So contact me if you have any questions about this, because it's a little tricky. But in general, we are going to expect bonds to pay us higher interest rate than dividends from stocks. But don't forget the growth. Stocks give us growth, where bonds really don't give us growth. All right. The pendulum swings on slide number 9. The bear markets of 2000 to 2002 and then 2008 changed investors' perceptions about dividends. We now see investors and companies focusing more and more attention on dividends. Dividends don't lie. I love that saying. Now, it's actually a book written by a woman who was based here in La Jolla, believe it or not. And they now have a new version, Dividends Still Don't Lie. Now, it's not the best book, in my humble opinion. You know, the other books on the bibliography are better, but I love the saying. Every single piece of information you get from the company in their quarterly and annual reports could be totally fabricated. And sometimes it was. Enron, WorldCom, Global Crossing, except for one number. And what is that? The dividends. How do you know? They paid you a check. They sent you a check. Well, they don't send checks anymore. They electronically send it to your brokerage account. But still, that's money in your pocket. Many companies that never paid dividends in the past are doing so now. Many tech companies with cash coming out of their ears. What do they do with it? Well, sometimes they make some pretty stupid acquisitions, but other times they say, you know what? It's time to give back to the shareholders. And so some of the major tech companies now are paying pretty darn good dividends. And the tax law has changed so that dividends are taxed roughly the same as capital gains. And this quote is attributed to John D. Rockefeller. We don't know if he actually said it because his neighbor said he said it, but it's a great quote. Do you know the only thing that gives me pleasure? It's to see my dividends coming in. So I love dividends. I love dividends, and so we're gonna spend a lot of time on dividends, folks. So stick with us. Now, there's a couple of phrases that you probably heard, so let's get them out of the way and make sure you know them when you're at the cocktail party talking about investments. Bull market versus bear market. Bull markets are favorable markets. The prices are going up, associated with rising prices of stocks, investor optimism, economic recovery, government stimulus. Bear markets are when the market is falling. Typically, the definition is a 20% or more fall in the stock market. If it's 5 or 10, 15%, that's just a correction. Well, where do the terms come from? Well, there's some couple of conventional wisdom or urban legend reasons, but really it's a lot trickier than that. Bulls tend to charge forward and throw their opponents up in the air, right? Where bears are more reclusive and they tend to knock their opponents knock their opponents down with their claws. But that's not really where it came from. So if you like the etymology of words, check out the real reasons. Okay? Now, let's review now. What are the pros and cons of stock ownership? Well, the pros are it allows the general public to share in the rewards of the business enterprise. Yeah, you and I can be part owners of companies that are there to serve the economy. Food, feed, clothe, and shelter ourselves. You could, you go to Walmart, you could buy shares in Walmart. You buy Nike shoes, you could buy shares in Nike shoes. You have a Ford or a Honda or a Chevy, you can buy shares in those car companies. You buy gasoline, you could buy shares in the oil companies. You see, this is the system that we use to feed, clothe, and shelter ourselves. And you know what? Capitalism might be just the worst possible economic system ever created, except for all the others. Nothing's perfect. They've been the best financial investment over time. And we're not talking speculations now. We're talking about bona fide, which is a fancy word for real investments. Dividends and capital gains. Now, The real estate agents will be jumping up and down and screaming, well, yes, we'll discuss real estate later on. They're very easy to buy and sell, so they're a liquid investment. Tomorrow, somebody will buy your 100 shares of McDonald's. And we talked about the limited liability. That means whatever we've invested, that's all we can lose. That's enough. Now, one thing we don't think of is that this system has created an increased standard of living for everyone all around the world, except for a few goofballs who are still clinging to the past. So I like to think about that. I like to think about how before COVID, the statistic was that more than 50% of the world's population had risen above the definition of middle class, world middle class. We're talking about hundreds of millions of people coming out of poverty. So and then COVID, stupid microbes shows us who's boss. But supposedly, I think we're close back to where we were before COVID hit. And then what are the cons? Well, dear students, do you want to eat well or do you want to sleep well? They're risky. Yes, they're volatile, which is a fancy way of saying, I lost a lot of money. If someone says to you, or so you ask somebody, how was that stock you bought? Oh, it's been volatile. What does that mean? It means they bought it for $11.88 and sold it for 30 cents. Do you know anybody who's bought a stock for $11.88 and sold it? I know somebody. I've lived with him all my life. He's kind of a goofball, teaches investments. It was a great stock, folks. It was based here in San Diego, Alliance Pharmaceuticals, and they were going to make synthetic blood in the laboratory. No more calls from the blood banks. Can we please come in? We need more blood. And you don't have to worry about testing that blood because it's built in the lab and it's going to be so cool and it's going to revel. It didn't work out too well, did it? Yeah, they're still asking you to come to the blood banks to donate blood. Yeah. And then, of course, the corporate and financial industry, hanky-panky. Yeah, oh well, dear students, what can I say? Because that's where the money is. So there's going to be fraud, gimmickry, accounting maneuvers, and we just have to be careful. And if we stick with the kind of companies, well, many of the companies that we'll concentrate on, companies that have been around for decades, have their roots deep in the economy, we shouldn't be hit with these scandals. Yeah. Slide number 12. Volatility explained. Now, here's that Standard & Poor's 500 list of 500. It's actually a little few more than 500, but still, it's 500 of some of the largest companies based in the United States. And the year 2024 was actually a very good year. If you had put $10,000 on January 1st into the stock market and then disappeared for a year, you could come back, you'd have over $12,200. You did pretty darn well, over 20%. However, those little rectangular mobile devices in our hands are always screaming at us and telling us what's going on. So immediately, your $10,000 fell a couple $100. And, Payano told me it's a long-term investment, so I'm not going to sell. And then you were rewarded with it going up about 10%. And then falling 10%. And you went, oh, no, I got to sell. So you sold, because at least you made a few $100, right? Your $10,000 was now $10,300, $400. Only to see it jump 10, 12, 15%. So you bought back in, only to see it fall another 12. So, no. And then you never touched it again and saw it go up another 10, 20%. Folks, it's a roller coaster, and you've got to be willing to ride it. And just believe that the system's not going to fail. We're going to survive. Because if indeed this whole crazy thing that we've created, this economy, capitalism, does lay an egg, does fall, crack, dissolve into a pool of tears. And there's no food at the grocery station. There's no gas at the gas station. There's no clothes at the mall. The cell phones aren't working. The utilities are not pumping out gas and electric. The trash is being picked up. The sewers are backed up. The hospitals, the schools, the fire departments, the banks, the police departments are all shuttered. Your stock investments are going to be the least of your worries. I'm very optimistic. Economically. As I said, I'm terrified politically, but go talk to your political science professor about that. The news has been good. I believe the news will be good. I believe we're going to cure cancer. We're already doing it. The days when people used chemotherapy will be thought of as the days when we used to use leeches or bloodletting. We're going to have driverless cars. Some of them will fly. We're going to have universal translators. We're going to have robots finally doing the dishes for us and cleaning the house for us. There's a lot of cool things coming down the pike. Now, those things, the artificial intelligence and are probably going to create more problems. They'll solve a whole bunch of problems, create more problems. But I'm very optimistic. We'll see. Terrified politically. Terrified. I don't like dictatorships. I don't want to live under one. So, are you excited? Are you ready? I hope so. Because now we're going to discuss, how does this thing work? Where are stocks and where are these things bought and sold? What's going on? What's the technology behind it? What's the system behind it? And we'll see that the changes have been monumental because of technology, and they're not going to stop anytime soon. Thank you so much for being in our class. We're so proud of you, dear students. We hope you're getting an education, and we want you to be awesome. We want you to be rich. Thank you for being in our class.